2012 was really the year that securitization reestablished its importance as a key component of a liquid and well-functioning global financial system, particularly in U.S. structured finance. Our view is that this will be further solidified in 2013 as some of the negative securitization rhetoric fades further and regulators, issuers, investors, bankers, other key market constituents really come to see that securitization post-crisis is on much more solid and reliable footing. The fact that we anticipate further growth in almost all of the key sectors, ABS, RMBS, CMBS, and CLOs, I think further validates how important structured finance is to the recovery of both the consumer-driven and the commercial-oriented portions of the economy. We believe that the U.S. structured finance sectors will likely not be impacted directly if we are unable to avoid the fiscal cliff. With that said, any structured finance sector could show some vulnerability to the knock-on effects that might happen in the event we do go over the fiscal cliff. On the commercial and the corporate side, increased taxes, slower spending, lower growth of GDP could impact the performance of both commercial mortgage-related products as well as CLOs. On the consumer side of the fence, any resulting increase in unemployment levels could have an impact on the performance of certain ABS sectors, although we do think that areas like credit card ABS and auto ABS will be able to withstand a significant increase in unemployment given their current low levels of delinquencies and losses. It's really all about confidence. So on the one hand, you have ongoing regulatory uncertainty, which is weighing on many market participants' confidence. In particular, there's aspects of Dodd-Frank, those related to risk retention that seem to be the highest on people's radar. Until there's further clarity and resolution there, I think it's unlikely that the market will make a full recovery. On the other end of the scale, you have the risk of overconfidence. So given the very strong performance of certain structured finance sectors over the past few years, it may be easy for some market participants to forget some very difficult lessons learned leading up to the crisis. In particular, the risk of excessive competition and the impact that that can have on underwriting quality. So in areas like CMBS and subprime auto, we're looking to make sure that those risks are not excessively observable. Ultimately, I think people need to remember that the structured finance market is still in a fairly fragile state of recovery, and until the issues of excess competition are addressed, the market won't have the confidence level that it needs.